Good morning and good afternoon to all the participants. Welcome to 𝗔𝗂𝘀𝗀 Masterclass. The topic for today is how to achieve digital world-class performance with AR automation. And let's welcome our masterclass speaker over here, 𝗔𝗂𝘀𝘀. He is the strategic AI advisor at 𝗔𝗂𝘀𝗀 Corporation. John, over to you. Thank you.
All right. Thank you, Akshay. And welcome, everyone. We have another good 30-minute webinar today that I think will provide some interesting insight into performance, particularly in the AR arena, and some quantification of what world-class performance is, at least according to the Hackett company's benchmarking. And then some of the actions, investments that drive performance to those levels. So we'll cover some of that in the introduction. Then we'll get right into looking at world-class performance in AR and how Hackett has quantified it for just a few indicators. And then we'll look at, well, what's required to achieve world-class performance in these areas. And basically, I've chosen to divide those requirements into two categories. One, foundational. Of course, we'll define those. And then two, automation capability, which is kind of where it ends up, right, in this day and age, as far as really achieving that extra high performance. I'll share with you actually a couple of case studies, summarize the benefits, wrap it up with a conclusion, and then answer any questions you have. All right. Let's talk about world-class performance, digital world-class, different terms used, but they all kind of coalesce around the same thing. Hackett Group released the study really just fourth quarter of last year. And in terms of finance performance, they found that digital world-class companies, 34% more efficient. I mean, a whole third, 40% fewer errors. What's really interesting here, particularly in the age of the Great Resignation and retaining employees, is 75% of their staff time is devoted to analytics, problem solving, analysis, versus just processing, key punching, data entry, less enriching jobs. And yet, they're able to achieve an additional 17% efficiency, 17% cost reduction over other current upper quartile performers. I mean, that's a big difference. It's a big premium for digital world-class companies. Now, it's not just technology. There's other things. Clearly, people process, right? Metrics, I think, is an important factor too. But digital technology seems to be the primary attribute that separates good performers from world-class performers. And Lord knows, companies and organizations have spent lots of time and effort on improving the process, implementing a best-in-class process, upgrading people skills, organizing them properly, choosing the right metrics and using those metrics. So I don't mean to minimize that. Been a lot of time and effort put into that. But as we head into this decade, clearly the differentiator is technology. All right, so let's define some of these world-class benchmarks. And there's many. I just chose 5. That kind of made an impression on me, somewhat easier to understand. So let's look at these, Hackett's benchmarks. Credit vetting, that is when you get a new customer or you're updating the credit limit on an existing customer. Well, let's look at a new customer. That new customer submits a credit application, and you have a reply to them as to what their credit limit is in 2 work days, 2 days. And that's elapsed time, not work time, but 2 days. That's quick. That's a quick turnaround. All right. You do that and you start to preempt the competition, right? Let's say there's a company out there and they say, you know what? Our existing primary supplier is okay, but they have some capacity constraints, have some reliability issues. We need to get a second or third supplier. Well, boom. If you turn that credit app around in 2 days, and it's positive, meaning you'll extend credit to them, chances are you'll be that second or third supplier, and you'll preempt the competition from being there. You're ready to go. Average days delinquent, a measure of collections, and it's a nice metric because it takes into account the payment terms you offer. So the world-class performance here is 4 days between your 4 days after your weighted average payment days, meaning if half your sales go out on net 30-day terms, half your sales go out on net 60-day terms, your best possible DSO, if every penny of every invoice was paid on the due date, your DSO would be 45 days. And to be a world-class performer in Hackett's view, your DSO would be 49 days. That is 4 days higher than the best possible terms. So again, that's pretty good performance. But that's the benchmark for world-class performance. Next one is cash application auto cash hit rate. Nothing saves time and effort and labor and cost like automatically applying cash. That's because Cash App is done every day, usually in pretty big volume. And if you allow it, it can really suck up a lot of time and effort and labor costs. So applying it automatically is the way to go. Interestingly, you'll see the benchmark here is 75% hit rate. And you're probably thinking to yourself, gee, that doesn't sound so good. We're at 80. Company I used to be with was at 83, 75. Well, not so good. But most of the companies in the Hackett sample are global companies, and they're dealing with multiple currencies, multiple banking systems, multiple languages, some lesser developed banking systems. So when you think of all that, 75% is pretty good on a global basis. Now, certainly here in the U.S., for U.S. operations, we've seen auto cash hit rates at 90% and a little higher. So just gives you a little perspective there. Next one, deduction resolution cycle time, 7 days, elapsed time. That's pretty good. I mean, that is good. And what's important about it is, remember, most deductions that come in the house, 95%, are valid. And you end up granting them, conceding them to the customer, which is a reduction in revenue. But about 5% are invalid. And if you research those and determine them to be invalid and bounce them back to the customer for collection quickly, like in 7 days, your chances of collecting them are much higher than if you wait 45, 60, 80, 100 days to bounce it back. At that point, the customer's moved on and very difficult to collect. So that's important. And then this last one is really amazing. It's the total cost of the credit to cash process as a percent of revenue. And I double checked this. This is 4/100ths%, not 4/10ths, 4/100ths, which is very, very low. And well, there's no way you're going to even approach that without automation. So how do you get to this world-class performance? I mean, those are some really outstanding performance benchmarks. Well, as I said, there's basically two ways. One is foundational capabilities. Now, I've got one slide on it. Don't mean to dismiss it. I know a lot of work, time, and effort goes in to becoming proficient here. But what are those foundational capabilities? Well, one is policy. Solid documented policies with clear exceptions. And then what I call work reduction policies. You can implement policies that save you a lot of work with very little economic cost. I've cited a couple here, but I'll just talk about the second one. Automatic small balance write-off. Customers take deductions. Most companies have a threshold below which they're not going to investigate the deduction. A lot of times it's $25. So if a customer takes an $11 deduction, you just write it off. You're not going to spend time and effort researching. If you raise that threshold up, you can eliminate a lot of deduction volume that needs to be processed at a relatively small dollar cost. And remember, 95% of those deductions are correct. So what you're sacrificing with your automatic small balance write-off is a potential opportunity to collect a portion of the 5% of deductions that are invalid. We had a client raise their small balance write-off to $600. Now, they had pretty big average invoice size, but $600. And that eliminated 42% of deduction volume. 42%. And only affected 2% of the value of deductions. So for a very small incremental write-off, they cut volume by 42%. Now, where else do you have an opportunity to reduce volume by 42%? I'd say you have to look pretty closely. So that's what we mean by a work reduction policy. What else in these foundational capabilities? Well, process. So much has been written and said about best practice process. Easy to say, kind of hard to get there, but to be a world-class performer, you got to be pretty close to best practice process. Metrics, to me, the key is the right ones and fewer rather than more. I've seen companies spend an awful amount of time and resource on huge reports tracking far too many metrics. Analytics, the insight analytics help you identify problems and identify solutions. And then good governance of a process. These elements are the foundation for success, but by themselves can't put you into that winner's circle. Advanced automation. And the phrase I use these days is hyper-automation. And there's a lot of different terms and names. I attempt to explain it. Hyper-automation is really a confluence of a number of technologies that have emerged in the last few years. Intelligent document processing, IDP. Robotic process automation, that's probably the most publicized, RPA. And of course, AI, artificial insurance. And all these technologies help your team interface and interact with your ERP much more efficiently and faster and more accurately. So if you're looking at a totally manual operation, these technologies can automate 70 to 90% of it. I mean, that's huge. hard to think of another productivity enhancing tool or technique that can generate labor savings of 70 to 90%. And it improves accuracy, speed, and reduces rework. So clearly, I think you can see you can be good with mediocre automation, but you really can't be great. To really get into that upper echelon, you need the latest automation. Here's a diagram. Don't get put off by the apparent complexity here. Let's just look at the boxes. At the far left is all the data that comes into a finance department. I call it the unstructured data store. And it comes in different formats: emails, faxes, EDI transmissions, lockbox reports. Some you have to retrieve it from your customers' vendor portals. Some you have to download it from your own EIPP customer care portals. And different file formats. It's a real mulligan stew of data, and it's unstructured. Well, the first step, intelligent document processing, extracts this data from these formats of almost infinite variety, and takes that unstructured data and converts it into structured data in a file. Then that file can be used for further automated processing, whether it's robotic process automation, which is best for simpler operations, less variation, high volume. And basically what the RPA does is it emulates human interaction with your ERP. Keying information in, processing it. The other way to utilize this data, this structured data, is through artificial intelligence, particularly digital assistants, which emulate, again, the way a human being interacts with your ERP, but also interacts with customers, suppliers, guides them through processes, assists them, and really accelerates basic operations. And beyond that, maybe there's some additional operations, but this really gets the data in great shape for fast processing. Let's look at a few functions in AR management, and we'll look specifically where this hyper automation really helps. Credit risk management. You get a new customer, they submit a credit application. Well, the vast majority of the work in a manual environment is just assembling all the information inputs you need to make a credit decision. Your credit bureau report, a bank reference, trade references, financial statement, a host of other inputs. You got to validate their legal entity, name, address, tax status, just a lot of things. Once all that information is gathered and done, the credit decision itself, simple and goes pretty fast, particularly if you have an experienced credit manager. But it's gathering everything together. And that's what this hyper-automation does. It gathers everything together. First of all, it enables you to have an online credit app, so no more hard copy. The potential customer fills it out online and signs it with a digital signature. So remember, you want a signature on that credit. Technology can do the credit scoring based on the DMB or Experian rating and other things, other parameters that you input. And of course, do the verification of the legal and the tax status. It can even make credit decisions to be approved by a human being. But think of it, all the grunt work, all the data gathering is done. And the credit manager just needs to look at it and make a decision. And then, of course, route it through a workflow for any approvals. So here's where the technology handles the most time-consuming tasks, the gathering of information. Where can it help in collections? And this is actually kind of interesting because you think of the old-fashioned done letter, which evolved into the old-fashioned done email, which can be easily ignored. Well, with AI dunning, it sends an email to the customer. If it's not acknowledged or answered, it repeats, to a limit. If it is answered, it can engage in a simple dialogue. Our records show you owe $18,000. That's over 15 days past due. Can you pay today? Answer comes back, no. Can you pay tomorrow? No. Can you pay by the end of the week? No. When can you pay? And at some point, a certain percentage of customers are going to say, all right, I'll pay next month. And then the digital assistant sets that up as a promise to pay and that sort of thing. And you say, well, that's probably still not really all that effective. Well, the answer is yes and no. Compared to a skilled collector calling, no, it's not all that effective. Compared to nothing or an old-fashioned done letter email, it's a big step forward. And we all know with collections, portfolio coverage is usually the biggest challenge. So, big step forward here. Cash App, talked about this before, but the IDP extracting the data from all these different customer sources, it's reading and key punching is what it's doing. That's a big part of the task and a big step forward in productivity. And it's also a big step forward in what I would call job enrichment. There's a lot of things to do, higher level, more interesting work. So you talk about the Great Resignation, people resigning. Well, here's an opportunity you can enrich the jobs as well as reap the productivity. Can also automatically create deductions, route them out for resolution, and then match debits and credits, do the small balance write-offs. This technology performs the most time-consuming parts of Cash App. Deduction resolution, same theme here. With artificial intelligence, a lot of these deductions, it can obtain the reason code from the customer, from their vendor portal, from remittance advice, files, whatever. Oh, we took an $800 deduction, code X. Well, you can find out what code X is. It's price. Okay. So now we got an $800 deduction for price, and you can route it to the person within your organization who's been designated as the person who resolves price deductions. So just getting them out quickly into the resolution process, huge, huge head start. That's how you get them done in 5 to 7 days. And of course, with the workflows, automatic matching of credits to the debits. But basically here, the artificial intelligence gets the deduction started on its journey real fast, and then once it's researched and resolved, and it closes the transaction, removes it from the AR ledger. All right. Quick case study. This is a narrowly focused case study. It was an organization that was taking 2 weeks to make a credit decision for a credit app. That's a long time. You got to ask the customer to pay in advance. Oh, they don't want to do that. I want their credit limit. I want it fast. Well, by using these technologies we've described, 𝗵𝗲𝗄𝐺𝑒's digital credit solution, to gather all this information, get signatures, validate kind of the legalities of this customer, they were able to take the 2 weeks down to 1 to 2 days. I mean, that's fabulous. That's within the Hackett world-class benchmark. And it's increased their capacity to handle credit applications. They're doing 200 to 300 a month. Another one, global medical product supplier, essentially implemented most of the technology we just described. Not only Cash App, but deduction, the collection dunning helped. And look at the results here. The deduction resolution cycle time reduced to 5 days. Remember, the Hackett benchmark was 7. Auto cash hit rate went from 50 to 80%. Hackett benchmark was 75. Again, operating in 30 countries with the variety and currencies, banking systems, et cetera, et cetera, et cetera. And the DSO went down. And that was primarily from exerting collection effort on those small and medium customers that were going untouched. And over time, kind of educated them that they were expected to pay on time. All right, let's look at the benefits. And I've been talking about them as we go. But the big benefit, and the topic of this webinar, was world-class performance. So if you're a upper half, third quartile performer, and you want to go to the upper quartile, upper 10%, this AI digital automation, this hyper automation will get you there. Other benefits, the cost savings. Not only productivity of staff, but also helps to reduce bad debt expense, lower your AR and your funding. Better customer experience because the response is faster, fewer errors, get better cash flow from AR, and it does enhance the jobs for your team. What's our conclusion from today's webinar? First of all, world-class performance in AR management is a competitive advantage. The additional cash resources, lower interest with interest rates going up, going to prove to be a bigger and bigger advantage over the next few years. We talked about the foundational capabilities. Don't need to ignore them. They're necessary. But what gets you into that upper quartile, that upper 20, 15%? It's AI-driven hyper-automation. Your questions.
Thank you, John. First question is, how does AI fit into the hyper-automation?
Well, it drives a lot of the capabilities, but particularly the AI digital assistants that go just beyond automating data input and gets involved with interactions with customers, vendors. I don't want to say decision making, but can help a customer, guide them how to make a payment on your customer care portal. So that's what really, I think, differentiates these technologies is the AI digital assistant.
Right. And next question is, what is the magnitude of labor savings delivered by AI automation?
Well, if you look at 100% manual operation, which, probably not all that prevalent anymore, you can see 70 to 90%. And think back to the 4 sub-processes we looked at. And we described which tasks the automation can perform. They were the more time-consuming, laborious tasks and the more unpleasant ones too. So that's where the major costs and labor savings come in.
Right. And the Hackett benchmark for credit vetting is 2 days of elapsed time. Is this realistic?
Yeah, it is. And we have a client that's doing it. So, kind of proof of the pudding. Remember, the bulk of the work with a credit application and the bulk of the elapsed time comes from gathering the information and validating the information needed to approve a credit limit. Well, if that's all automated and done quickly, the actual credit decision is not that difficult or time consuming.
Right, John. Thank you very much. I think we are almost through with our time. In fact, past 2 minutes, our scheduled time. Well, thanks a lot for all the attendees. I would request you all to send an email at info@𝗵𝗲𝗀.com for any questions that you may have. And looking forward to you joining us for our next session on 12th of May, 8 a.m. Pacific, which is going to be a Thursday. And our topic is going to be 2022 trends in integrated invoice to cash automation. Look forward to seeing you there all. Thank you very much, John.
My pleasure. Thanks, everyone. And we'll see you in 2 weeks.
Thank you.